A stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business with an underlying value that does not depend on its share price. That is a quote from the legendary investor Benjamin Graham. What does it mean? That's what we're going to discuss in this video. Valuation is the process of determining the current worth of a company's stock. It is an assessment or an appraisal of the stock's true value, what it's worth as an investment. Valuation gives us a reference point to answer whether a stock is fairly valued or selling at about its underlying value, to use Graham's term. Underpriced, meaning it's selling at a bargain price, or overpriced, meaning it's selling for more than it's really worth. As investors, we're always on the prowl to identify when an excellent company is selling for a price below its true worth. That can happen, and does happen, when, for example, the entire market is in a slump, taking all stocks down with it, or a company suffers a temporary setback that will make no difference in the long term, but which causes its price to fall on the market in the short term. Or a company may simply be mispriced, sometimes for a very long period of time, more than a year, by the market. Hi guys, I'm Dave Van Knapp with the Dividends and Income channel. Please click the thumb up button if you like this content, subscribe to our channel, and ring the bell to get notifications when we post new videos. All those things help us out a lot. Thanks. The term intrinsic value is one of the most common ways to express what Benjamin Graham was talking about. But it's not the only way. Intrinsic value is synonymous with the things listed on the slide, such as fair price, true value, underlying value, inherent value, and fundamental value. Basically, what we're trying to get at is an estimate of the underlying value of a company's stock, meaning how much is each share really worth right now. Intrinsic value, or any of those other terms, are not synonymous with a market price. The market price, think of the market as a grocery store. You go into the grocery store and you pick up a can of beans, and there's a price mark on the can or on the shelf label right below the can. That's what it's selling for, but it's not necessarily what it's worth to you. Same thing with stocks. Each stock comes with a price determined by the market, but that price may not accurately reflect what the stock is actually worth. In figuring intrinsic values, moving to the last item on this display, there is no single universal methodology of how to calculate or estimate intrinsic value, so the estimates differ. Intrinsic value is not a physical quality of a stock. It's not like the width of my desk or how much I weigh when I step on the scale. It can't be measured with a ruler or a gauge or a scale. Rather, it needs to be estimated using some numbers, relevant numbers, and a good deal of logic. Okay, price and value are different. We've just described what intrinsic value is. It's an estimate of the fundamental value of a stock. Let's contrast that with market price. Market price is simply the quoted price that you can buy a share for on the open market. Technically, it's the last traded price that a buyer and a seller agreed upon in making a trade. That price is recorded, and until the next trade is made, that quote-unquote is the price of the stock. In reality, the share price often differs from intrinsic value, sometimes a lot. And I made this little display to illustrate that. This is just a hypothetical, but say that a stock is selling for the price above the yellow arrow on this display for $148 a share. But you do some calculations or look to some sources, and you decide that the actual value of the stock is $200 a share, shown here by the orange arrow. This is a perfect illustration of how share price often differs from the share's intrinsic value. This would be an illustration of massive undervaluation, and if you like everything else about the company, it would be a good time to buy the stock. And sometimes those arrows are reversed. There are many cases in which the actual value of a stock is much less than the price it's selling for on the market, and generally that would mean that that's not a good time to buy that share of stock. And that concept of the difference between share price and share value or intrinsic value is the basis of one of Warren Buffett's most famous quotations ever. It's simple. Price is what you pay, value is what you get. And that's what we've just been talking about, and we're going to continue to talk about throughout the rest of this video. In value investing, you create what is called a margin of safety by not overpaying for a stock. And this slide contains a summary of what we mean by margin of safety. Number one, the margin of safety is the difference between your estimate of the stock's intrinsic value and the price you pay. And it's usually thought of in percentage terms. So you could say something like, I got that stock for 15% less than it's worth, or 5% less than it's worth, something like that. Point number two, the larger the gap between the price you pay and the intrinsic value that you've calculated, the larger the margin of safety is. I think that's pretty obvious. In section number 3 on this slide, I list some of the benefits of having a margin of safety. You have a lower price risk. The less you pay for a share of stock compared to what you think it's worth, the more likely it is you've improved the odds that its price is going to go up or not go down very much from what you paid. You get a better yield on that share of stock. Yield and price are related inversely. As price goes up, yield goes down, and vice versa. So as price goes down, yield goes up, and by paying a lower price, you get a better yield. It leaves room for error in your assumptions. That's one of the most important things. I maybe should have listed it first here. Since intrinsic value estimates are estimates and not things that you can measure with a ruler or a scale, there's room for error, or errors will be made. Projections will be over-optimistic, say. The larger the margin of safety you establish by the price you pay versus what you calculate the intrinsic value you are getting, the more room for error you leave for having made mistakes or used bad assumptions. And all of that leads to the last point, you sleep better. If you know that you're underpaying for most of the things that you buy, that's a better feeling than worrying about the fact that you overpaid for most of the things that you buy. The last point is very important. Establishing what appears to be a margin of safety at the time you buy a share of stock does not shield you at all from short-term price declines. Obviously, for all the reasons such as errors that could have been made and the utterly unpredictable moves that happen on the market, you may find that the price goes down for a period of time, maybe for a long period of time, after you make a purchase of a share of stock, even though you created what you thought was a good margin of safety. That's just the way the market works, and that's some of the inherent risk that we all face in buying things from the stock market. Okay, let's move on now to valuation models and how we actually value a stock. Valuation models split into two broad categories that are widely accepted in the industry. One set of models is called absolute models, shown on the left here, and the other set of models is called relative models, shown on the right here. Here's what distinguishes those two categories from each other. With absolute models, we build a fair price or an intrinsic value from the ground up using only data from the company itself. Whereas with relative models, we use the stock's price in assessing its intrinsic value. Its price on the market, which we have already seen, may differ from intrinsic value, but we use that as a starting point to arrive at intrinsic values. So the two kinds of models are inherently different. The first model on the left, the first absolute model, and far and away the most widely used, is called the discounted cash flow, or DCF model, and that's what I'm going to focus on next. Here is a simple graph from a wonderful site that I urge you to visit called moneychimp.com. What this graph shows, it's a hypothetical of the earnings for 40 years, or the cash flows for 40 years of a hypothetical company. And you can see that some growth is expected in the company's earnings. It becomes more and more successful with each passing year, and they go up. The blue bars go up in this hypothetical at the rate of 8% a year for the first 10 years. And then to be safe and conservative, there's no growth built into the model after year 10. The bars just become level. The company's earnings or its cash flows are no longer presumed to be growing beyond year 10. This slide shows those same earnings discounted back to the present. In other words, what the company's future earnings year by year are worth right now. They become smaller and they go down with each passing year. That is in recognition of what's known as the time value of money, which means that a dollar to be received in the future has less current value than a dollar right now. The process of figuring out these green bars is called discounting. The discount rate used here is 11% per year, which is an estimate of the long-term return of the stock market. You could also look at that discount rate as your required return when you invest in the stock market, meaning what you expect to get from investment in the stock market. So the green bars represent the present value of the blue bars in the prior graph. If you stacked up the green bars into one taller single green bar, that would be the theoretical current value of the stock. As you can see, the further out you go, each year's green bar adds less and less to the stack. And the contribution from the bars out beyond, say, 20 to 25 years becomes almost negligible. It's really the closer in years that add the most value to the calculation of intrinsic value under the discounted cash flow model. Okay, here's what we just talked about in a nutshell. Number one, the present intrinsic value of a stock is the sum of all of its future earnings or cash flows discounted back to the present. Number two, discounted cash flow, the model, accounts for the time value of money. Money to arrive later is worth less than money you already have now for several reasons: inflation, interest rates, other opportunity costs, meaning what you could be earning on the money if you didn't invest in the particular stock that you're looking at, and the lack of risk. If you don't make the investment and you have the money right now, obviously you have it right now. There's no risk of waiting for it to come in later years. Number three, to calculate discounted cash flow, you need to estimate the future cash flows of the company and select an appropriate discount rate. And finally, the results are very sensitive to those two inputs. They are themselves educated guesswork and estimates, and the rule of GIGO, garbage in, garbage out, applies to all estimates of intrinsic value that are based on discounted cash flow calculations. Now let's turn our attention to the other kind of valuation that we saw on the flowchart slide earlier, which is called relative valuation. In relative valuation, we relate the stock's price to fundamental values, financial values from the company. Some examples are shown here. We could relate the price to the company's earnings and form the PE ratio, price divided by earnings ratio. We could relate the company's price to the company's book value and get the PB ratio. Or we could relate the company's price to its future projected earnings. Each of these ratios is called a multiple. For example, if a stock is selling for 15 times its earnings multiple is 15. Point number two, once we have the multiple, whichever one we've chosen, we compare it to a benchmark to determine fair value. And there are some examples here of the benchmarks we can use. The stock's own historical average for that multiple, the average of other stocks in the industry at the current time, or the average of the whole stock market over a long period of time. And the last point about relative valuation is there are scores of multiples that could be used. Maybe 10 or 12 are commonly used, but the one most commonly used is the price to earnings ratio. That's what I use, and that's what I'll be focusing on as we talk about these ratios. The price to earnings ratio is easy to find for all stocks, and it's straightforward to interpret. Relative values are like house assessments. The idea is to if you're getting a house valued, if you've ever done that, you know that the estimator, the the appraiser looks for what are called comps, or comparable properties to yours, and those become benchmarks for comparison. In valuing stocks using a relative method, we're doing the same thing. We're comparing the valuation of our stock against logical benchmarks for the same kind of company, possibly historical benchmarks for the actual stock we're looking at, and sometimes to the market as a whole. And now for the part you've all been waiting for, how I value stocks. What I'm going to describe is my go-to process for valuing stocks. I sometimes make variations for special circumstances, but this will give you a firm understanding of what I normally do and why I do it. Plus, I'll have a real-life illustration of the theoretical stuff that we've been talking about. Here's the overview. I use 4 valuation models and I average the results. That's usually pretty easy to do. I can value a company in about 5 minutes, and with a little practice, you can do it too. This graph illustrates the first 2 models I use. The stock here is Merck, and the graph comes from FastGraphs, which is a service which plots the stock's actual price, which is the black line on this graph, against one or more benchmarks for whatever multiple you are using. And in this case, I'm using the price to earnings ratio. The 2 colored lines on this graph represent my first 2 models, which are based on 2 different benchmarks. The blue line is Merck's 5-year average price to earnings ratio. That is calculated by FastGraphs and drawn on the chart for me. The pink or magenta line is the current price to earnings ratio of the healthcare sector. Merck, as you probably know, is a pharmaceutical company, and it's in the healthcare sector. I retrieved that benchmark myself from another source, and I inputted it into FastGraphs. That's an option with the service, and then they draw the line for me. Because in my valuation process I use different models, I need to pull them together with a simple, consistent way to express the result for all of them, so that I can take the average of them at the end. I convert all the information to valuation ratios, which simply means the ratio of Merck's actual price to its fair value as determined by each model. On the graph, those ratios are illustrated by the 2 red arrows that I drew on the graph. The length of the arrows corresponds to the margin of safety between Merck's actual price, the black line, and the fair price suggested by each of the 2 benchmark lines. This slide shows the simple calculation of the valuation ratios for these first 2 models. Model 1 is the current PE ratio divided by the normal or 5-year average PE ratio. I get the numbers from FastGraphs itself, and when I do the calculation, you can see the result there is 0.875, and I'll explain how to interpret these in a moment. Model number 2 was the current PE ratio divided by the sector's PE ratio, so it's 14 again is the numerator divided by a different denominator, in this case 17.7, and the result was 0.79. Both of those valuation ratios suggest that Merck is undervalued because they're both less than 1. Plus, visually, we could see that the black price line on the earlier graph was underneath both of the valuation reference lines, indicating undervaluation for Merck. Okay, my third model is a discounted cash flow or DCF model, and for this I use Morningstar. On this chart, the black bars are Merck's prices going back 10 years, and the red line is Morningstar's changing discounted cash flow valuation of fair value over the same 10 years. We're only interested in the current comparison at the far right of this chart, and I've circled where Morningstar has calculated it out for us. They use a price to fair valuation ratio just as I do, and they've calculated Merck's price to fair value ratio as 0.99. I simply read that number off of this chart, and that becomes my number for this model. So here are the valuation ratios again with Model 3, Morningstar's DCF valuation, added to the list. Just one more to go. Here is the last model I use, the relative yield model. The idea behind this model is that over long periods of time, the market will tend to price a stock so that its yield stays about the same. So if the company's current yield is higher than its normal yield, that suggests that the company is undervalued. And vice versa. If the current yield is lower than the normal, that suggests the stock is overvalued. This display from Simply Safe Dividends provides all the information we need to make the simple calculation, along with a nice graph. The calculation is simply divide the normal yield by the current yield. Okay, I've added Model 4 to this slide, and now we have all the valuation ratios from the 4 methods that I usually use. Model 1 gave us a 0.875 valuation ratio, and you can read the other ones down. Model 2, 0.79, Model 3, 0.99, and Model 4, 1.07. Now that we've got our 4 valuation ratios from the 4 valuation models that I use, we need to interpret them. Here's the basic 3 steps on how I do my own valuations. Number 1, I simply add up an average, take an average of the 4 valuation ratios. That gives me a single average valuation ratio. Step 2 is I calculate the fair price of the stock, and I do that simply by dividing its current price by the valuation ratio. And step number 3, I put ranges around the fair valuation number that I've calculated to create buy and don't buy zones. In that step, I'm remembering and ask you to remember that we're talking about creating margins of safety. So when I say I put ranges or bands around that fair value price, I do it to guide myself in whether to make, say, a purchase decision of the stock at its current price. Sometimes I do that generically. I just go 5% up and down from the fair value price. Anything more than 5% above the price is considered to be overvalued. Anything more than 5% below the current price or the fair value price is considered to be undervalued. Or I could go 10% or 5% in one direction, 10% in another direction. It becomes a matter of judgment, keeping the margin of safety principle in mind. In an optimistic time, if I'm really confident in my calculations, for example, or the market is in a general uptrend, maybe I won't require any discount to the fair value calculation at all. Or I might even be willing for a very high rated stock to pay 5% or 10% more than I've calculated the fair value to be. In the opposite direction, I could be pessimistic. I could require a 15% or 20% discount to the fair value price to create a really large margin of safety, just because that's the way I feel about my calculations or about the quality of the company. Sometimes for A-rated stocks, A-rated quality stocks, I require no discount or only a small discount to fair value. But for stocks that don't come out as A-rated but are still investable, the way I do quality snapshots, I might require a 10% or 15% discount. I think you get the idea. The idea being that you calculate the fair value of the stock. That's an objective number. You can run it out to 5 decimal places if you want, but you don't know about its accuracy. So a number can be precise but not accurate. So putting ranges around that fair value price is where you account for possible mistakes or miscalculations or bad projections that you've made in calculating your fair value price. Okay, going back to our Merck example, here's how it all worked out for Merck on the day that I did these calculations. First, calculate the valuation ratio. You can see that I added up the 4 individual ones, then divided by 4, and I got 0.93 as the valuation ratio I'm using for Merck. I calculate then in the second bullet the fair price for Merck. On the day I did this, Merck was selling for about $93, so I divided $93 by the valuation ratio of 0.93, and I get a fair price for Merck of $100. And then I choose ranges above and below the fair price, and for Merck, which is a very high quality stock, I just did the simplest generic thing and made my ranges plus or minus 5% above and below that fair value. Okay, we're almost through. And I need to say, my description an explanation of how I calculated Merck's fair value and how fair values and intrinsic values work all together took way longer than it actually takes to do this calculation. In fact, this is a snapshot of the slip of paper that I actually did Merck's valuation on before I created the slides that I needed for this video. You can see there's a line for each of my 4 models. I just abbreviated those: Fast Graphs 1, Fast Graphs 2, M star, which is Morningstar, and SSD, which is Simply Safe Dividends. The individual values are out to the right, as I showed you on a slide. I added them up, divided by 4, got the overall valuation ratio of 0.93. Then I looked up Merck's price. It's $93, divided by 0.93, and that's how I got the $100. So earlier in this video, when I said I could value a stock in 5 minutes or less, this is literally a view of how I did do it for the stock I ended up using as an example for this video. And when I do a video, I make everything look pretty. So here's the pretty version of what we've been talking about. Merck's valuation snapshot. The fair price shown just to the right of the blue arrow is $100, so we've seen how that was calculated. The fair range, the yellow range above that, is minus 5% to plus 5% for the price, which brings you between $95 and $105 is a fair price in my estimation for Merck. Anything above $105 spills over into the orange column, too much to pay, more than $105. Anything less than 95 is a discount price. And at the bottom of the slide, I say at the current price of $93 and yield of 3.0%, I consider Merck to be 7% undervalued. And when I make these slides, I put a blue arrow to point roughly to where I'm talking about for easy interpretation for you guys. And that's it. That's how I do valuations or valuation snapshots for stocks when I'm talking about them in my videos. Please use the comment section below the video to comment on the video or to ask questions. I am active in the comment stream, and I do answer legitimate questions, and I also go in there and I eliminate spam, which hopefully you guys don't see too much of, but it does occur, and I try to get rid of it. With that, I will say thanks very much for watching this video. I hope it has helped you, and I'll see you next time. Goodbye, everybody.